Okay. Hi everyone. It's just gone 10 a.m. in Vancouver. Uh, it's 7 p.m. here in France, and it's 4 a.m. in Australia. So we can safely say none of the Australian investors have dialed in today. Just a little bit of housekeeping for everyone. I'm going to put everyone on mute. So there's no background noise or feed. And I think you can actually signal on Zoom if you've got a question, but I'll open it up for discussions at the end. I've also got some questions to go through. Another point: this is open to all interested parties. This is not restricted to shareholders, and it's not to be conceived as that. It's an open discussion for existing, future, or past shareholders can just get an update on what's happening at with Meridian and the Cabaçal project. So what I was going to do is I'll go through the corporate presentation. I'll then go through a set of long sections and cross sections of the deposit. I'll give an outline of what the results mean, and I'll also give a bit of perspective on the market, and then go through I'll answer the written questions then, and then if anyone's got any additional questions, we'll work together so there's not, everyone's not throwing them all at once. The meeting, some people have just joined, the meeting will be recorded and we'll upload this to our YouTube channel. Okay, I'm just going to share my screen with everyone. Okay, excellent. So over the last 18, nearly over 2 years, but really in the field of the last 18 months or so, we've been drilling and defining the Cabaçal copper gold mine, copper gold resource we can state now in Mato Grosso in Brazil. We've done this with a very focus on cost. We've achieved our first resource statement just recently, and it's quite a significant one. If you look at the United States Geological Service, I think by tonnage we're in the top 4%, and by metal content we're in the top 15%. As is the public discussion, I'll just take a minute or so for everyone to take time to look at the public disclosure. The resource statement that we published, it was done at a deposit scale cutoff grade at 0.3. That gave us over 52 million tonnes in indicated and 10 million tonnes in inferred. For the people who are unaware, indicated is a higher certainty of mineral resource category. We did have sufficient data within the old workings to potentially have had a measured resource, which is even higher than indicated. One of the reasons why we didn't do that was we had underground maps which we digitized, but we didn't have what we call a laser survey, which is much more accurate. So for that matter, rather than having the risk of inaccuracy in the digitizing of the paper, those areas where we could have had typically had a measured resource, we've actually included that in the indicated. That's given us quite a significant gold equivalent over with the indicated and inferred. It takes over 2.1 million tonnes. An incredible amount of gold, 1.1 million ounces, and 1.3 indicated and inferred, and contained copper, 192,000 tonnes of contained copper. We're going to talk about this a little bit more, how strong and robust the resource is, but really why we see it being the potential to become a long-term production asset, and that really centers around the geometry of the deposit and the metallurgy of the deposit. So what we're looking at here, we call this is page 4 of the presentation. The top diagram is what we call a long section. It's a cut along the length of the deposit, and this is the measured and indicated. And you can actually see that It's very, very continuous and strong mineralization all the way through. Particularly you'll see in the old Cabaçal mine area, we've had a lot of drilling there from historical, and we actually saw a lot of this is more of a copper-rich center, where the Cabaçal Northwest Extension is a gold-rich center, but still has a presence of copper. The lower diagram is just a resource block model that you can see the topography. And what's really notable about this is what we're looking at here is a lateral traverse through the mine. It gives an extent of how robust the mineralization is. And then what we're looking at in the bottom diagram is if we take a cut through the topography, you can see that the Northwest Extension is very much up a hill. And that hill, what the benefit of that for us is when you look at a mining scenario, we're going to focus our initial mining studies on the Northwest. And that means a lot of that, typically you have trucks coming out of the pit. In this instance, we'll have trucks going down a hill, and that is an energy saving. When we look at the block model of Cabaçal, it's made up of literally three-dimensional blocks, 10 meters long, 10 meters wide, 5 meters high. And within that's populated with the amount of gold, the amount of copper, the amount of silver that's been estimated by the software. But even as we drop the grade, as we go clockwise from the top left, it still retains a very robust and continuous block of mineralization. Even at the higher grades, you can see that the higher grades, the very high grade core, it runs the length of the 1900 meters of strike. What we're going to focus on our initial studies is a block model at the top right with a 0.5 gram cutoff, which is a very high grade cutoff for us, much higher than any other operating gold or copper mine in Brazil today. And that gives us some 41 million tons at about 1.25 or about 0.93 copper equivalent, 1.25 gold, 0.93 copper equivalent. This is really one of the most interesting points that I'd like to just stay on for a moment. It's the grade tonnage curve. So even as we increase our cutoff grades, we don't see a dramatic drop off in the tonnages. And that's just a reflection of the robustness of the model. On the total metal split, we can see there's 57.5% of the value of the metal, that's the recoverable metal, is in the copper, is in the gold, and 40.9% is in the copper. And there's a little bit in the silver. So there's a perception that, did we transfer from being a copper project to a gold project? Well, in this instance, what you have to look at is how these metals will be commercialized, and the gold and the copper are intrinsically associated. So when we look at our assumptions and forecasts of metal distribution, 80% of that value of the gold, of the copper and the gold and the silver, that would be commercialized through the copper concentrate, and 19 or 20% will go through gold doré. So we're going to have an incredibly, again, I have to use cautionary language, potential concentrate, which will have a very high gold content, and that's incredibly valued in the market today. When I look at that, that's the type of copper concentrate that I want to have. Very clean, very good grades. So we're targeting 27% copper, above 15 grams per ton gold. I think it's going to be a little bit more. No impurities, readily bought and designed by the copper smelters around the world. The benefit of this is, if you're a company or a smelter company and you're buying copper concentrates, if you've got a copper concentrate that has no impurities and very high grades, you can blend that, and that actually attracts a very good price. If you have a copper concentrate, if a mine produces a copper concentrate that has a lot of impurities, that gets bought cheaper and it has penalty prices. But what smelters do is they take the copper concentrate that's very clean, they buy the cheaper stuff and they blend it, so they get an optimal smelter performance. So this is why I see our potential copper concentrate being highly desirable in the market. When we look at the cut-off grades, we reported 0.3 and as a global resource, but we're very much focused on this 0.5, the high-grade core, the very high-value core of the deposit. This is the one that allows us to do our next phase of economic studies, engineering studies, based on this 0.5 cut-off that gives us that 41 million tonnes of inferred and indicated at about 1.23, 1.24 grams per tonne gold equivalent. This is really a very robust financial amount of dirt to work with. It's very strong grades, it's evenly distributed. But however, one of the better things about Cabaçal is, although the grade is evenly distributed, although it's very shallow, regardless of what grade we mine, we're going to achieve very high metallurgical recoveries. So when you see we're saying we're going to get 1.05 gold, 1% or 0.9% copper equivalent, or whatever figure, you can readily assume that that's going to be very high recoveries. For copper, so we know that probably about 70% of the gold is actually going to float the copper. Anything above 0.1% or 0.15% copper, we are going to achieve 90% recovery in the flotation. This is very important for us. Now, the other aspects of the metallurgy, which I'll touch on why it's important to the deposit, is the nature of when we go to process the plant, in the design of the future studies and the end results. We can produce up to 29% if we choose to, but it's quite an aggressive grade. We'll settle on 29. We talk about it has a very coarse grind. That means we only have to grind it the first phase down to 200 microns. Now, the question is, what is the importance of having a coarse grind? Well, it's energy. Okay, everything in mining is really about energy management, because it can be quite a large element on your CapEx. Sorry, on your OpEx, operational expenses. So this means we don't have to grind it down to very, very fine, a very fine, 10 or 15 micron, which is finer than powder, flour. So that means we don't have to produce a lot of energy to do that. Our dominant mineral that hosts everything, or present in the deposit, is the sulfide mineral, is a mineral called chalcopyrite. This is the most common copper hosting mineral. And what's important about that is you want it to float off very quickly. And as you can see here in this bottom right photo, it's very brassy colored. That's chalcopyrite floating up very quickly. Because if it takes a long time for the chalcopyrite to float, what you have to do is you've got to have a lot of electricity circulating the material, crushing, grinding, flotation, pumps, agitators. That's energy, that's high energy consumption. So by having a very rapidly floating chalcopyrite, we have a low energy requirement to go through that process. Then the next phase we talk about here, what we call the bond work index, and that's the amount of power you have to introduce to break the rocks. It is very low. We have soft rocks. There are parts where we have some quartz veining associated with gold, and that can require additional energy. But overall, we have got a very low bond work index. So that means we don't require a lot of energy to break our rocks. We are required to grind them very fine. So all these attributes that we've identified, more confirmed than identified, we knew this when we started, means that we don't need a lot of energy. Now, if you live in North America, Australia, Europe, energy is a big concern for industry. We have very cheap energy in Brazil, but we've also got a very low, by comparison to other deposits, an energy requirement. Just one thing there, like the abrasion index, I won't go into that. That's more about how many millimeters of iron worn away per ton of processing, but ours is very low. The last thing I'll talk about just on this metallurgy is non-acid generating tailings. This is very important when we look at permitting the process of getting permits granted. If you were to look at an aerial photo of Flin Flon, you'll probably see a big orange lake. That's a big lake of acid water. I think it's still there. And that's acid. We did, as part of our metallurgical studies, we looked at the acid generating capacity of, we've designed a process of extracting the ore. It's very, very simple process. We grind the ore to 200 microns. We put the mineralization through a gravity circuit. We take out about 30% of the gold. We then go through a flotation circuit. We take out the first pass of copper, the chalcopyrite. Then we do a second pass where we grind it down to approximately 40 microns. We take out the last copper and gold. And then we've got a final circuit where we take out the remaining, the principle of these minerals called pyrite and pyrrhotite. Why we do that is we produce a concentrate of basically sulfur minerals, and that doesn't go into the tailings dam, so we don't have acid generating tailings. It's very important for long-term liabilities and permitting. So this is why we mentioned these things in the presentation. This is just a couple of the simple cross sections. We're going to go through these in detail in the next presentation. One thing to take away from this, this is the indicated and inferred. No, beg your pardon. This is the indicated category. One of the common things with copper mineralization, it doesn't affect the gold, is if the rocks are oxidized, they've been interacted with oxygen and water, the chalcopyrite has been oxidized, it goes into a different type of formula. It's very difficult to recover through the flotation process. Currently, we don't have any data on the metallurgical characteristics of the top 20 meters of the deposit. So what we did in that top 20 meters is we assigned zero recovery for copper. There's copper present, there's gold present, but we didn't, the gold is included, but the copper is not. This is by far probably the most important page to discuss in respect to future financial assumptions and modeling of the deposit. In every mining evaluation that a person would do, the question is, how big is the deposit, how big is the mine, and how fast will you pay back the project finance? Because you don't want to keep paying, paying the banks for 3, 4, 5, 6, 7 years the debt that they'll give you for the project. Now, in our Cabaçal deposit, we're looking here at some 1900 meters. Now, 41 million tons of what we're focusing on for the start. And the Northwest Extension, we've seen that in the news releases, some very high-grade gold intercepts. And they're very shallow. Sometimes we have gold starting at 20 meters below surface in the massive rock in it. And it's quite extensive. We've said that there's a layer of gold up there. There's not only a high-grade vertical veins, there is also lateral layers of gold mineralization, and there's also copper associated with this. So it's still going to be recovered through that same metallurgical process that I talked about before. But what this achieves for us is we will have a very concentrated amount of metal at very shallow depths. So we focus our initial mine planning studies on this area so that we aim to pay off the debt component of any future project finance as quick as possible. So if you have a common scenario, you buy a house and you have a deposit, and then you've got to pay off your debt to the bank. But if you pay off more than the monthly amount, the debt gets paid off quicker and you pay less interest. It's the same, almost the same principle in a layman's term. We have been looking at, we didn't stop drilling. We once we'd reached a critical mass of data to do the estimation, we shut down one rig completely. That's gone from site, and we demobilized. We had 4 drill crews, so we had 4 teams of drillers, so 3 working at day shift and 1 working at night shift. And we also got rid of 2 crews. So currently, effectively, we reduced our daily rate of drilling by 50%. So since, I guess it was early August, late July, when they finally demobilized, the amount of drilling that we've been doing and the cash related that has dramatically dropped. And you know, we're not putting out masses and masses of meterage each week like we were doing in the first 2 quarters of this year. But we still have areas within that resource statement. We still have areas up dip and down dip which are unclosed. We can see that in the sections that have been on public display now for some weeks. So we have been focusing one rig there. At the same time, we've really got a very exciting exploration. We've always said that, you know, Cabaçal is the standalone asset to look at developing the entire belt. So we've had one other rig on the C4A target, and progressively, as the drilling dies down from Cabaçal, that exploration activity will be continued. What is our exploration upside? A lot of companies have single assets. Cabaçal has never had a single asset. We've always had about 7 or 8 potential company-making deposits, or prospects, I should say, prospects within our tenements. And at the same time, we've also found, by example, the C4A gold discovery. So what our exploration potential won't be finished in 6 months. It won't be finished in six years. It will take many decades of exploration work. As per every other VMS belt that is out there today, the only difference, these belts are subdivided perhaps with 20 companies. Our exploration upside is in one company, and it's going to go for many, many, many years for decades to come, which is very positive for the growth of the not only the potential resource growth, but also the potential resource, the equity growth for the company. How far away is this? Well, like we said, we want to have Cabaçal to be the central focus of developing an economic mineralized belt. And we can look at 5 kilometers away, 5 kilometers away, we've got targets to the northwest, the C4B, we've got the C2A, which is quite a large trend. And then recently what we talked about in the market was what we call the C2 trend, which runs from the Alamo in the southeast. It runs back to the northwest past the St. Helena mine, and it goes up to the security target. Now within that, it's probably it has to be one of our most densely populated area for electromagnetic anomalies. We have a lot of soil anomalies. We have open drilling. We have the security where they drill a meter at 140 grams gold. We actually have a typical massive sulfide at the St. Helena mine. That was only half the massive sulfide was mined there. We told the market there's a 1,300 meter long gold trend there that's never been followed up on. And the Alamo, which is potentially our largest prospect, the Alamo is some 4.5 kilometers of conductive EM anomalies. And these EM anomalies have a very similar amplitude or signature to what the electromagnetic anomalies had over the copper-rich system at Cabaçal. So we don't have one target as upside. We don't have 2 targets as upside. Our upside is measured, probably it is 15 or 20 different prospects we could look at across this belt. And that is absolutely the norm for VMS belts. VMS belts are clusters of deposits, and we are replicating that now at Cabaçal. We are replicating that at Cabaçal now. And again, this is the attractiveness of our equities. We have now got a standalone asset, a very promising, a very strong asset of some 40 million tons at 1.2 grams gold or 0.92 copper equivalent. But our upside is not a single project. Our upside is multiple projects along a 52 kilometer strike now. The project is going well. We've got we'll be publishing an updated 43-101 shortly that will include the resource statement and elements of the metallurgy. We are going to be doing our engineering and advancement of the project. This has been in the market now since we started the deal, because that was the conditions of the purchase agreement with the vendor. Throughout that period of focusing on the vendor agreement, we will continue to go look at the exploration and the discovery potential of the VMS belt. Often you'll have a company that will have a go into the phase of preliminary economic assessments or pre-feasibility studies or then feasibility studies, and they don't have the upside of other projects to maintain momentum and interest in the market. Our upside was predefined back in 1980 by BP. It's just sat there for 30 years, 40 years even, getting close to now. It was discovered in 83, so yeah, close to 40 years now. So our upside has already been predefined. That first phase of high-risk exploration, which is typically funded by the junior market, that was financed by a major. We've recovered the data, we've done additional data. So we see not only the great strength of the Cabaçal deposit and what we think are going to be very strong future economics, but also that upside presented to the shareholders, existing or new, about where we're going. Capital structure hasn't really changed of late. We've still got, there's one question there. I can just identify this now. One of the question there was, what's the inside holding? On a fully diluted basis, where inside holding is approximately about 30% of the company's held within very secure people, be that institutions, board members, a lot, strong shareholding. We've got a lot of warrants coming in. We've got potentially 1.8 million in future cash coming in before the end of this month. Look, there's been some volatility in the market recently. A lot of volume, but also a lot of buying. I would say that there's probably some shareholders who own those 30-cent warrants. They're probably selling a bit of their paper to raise capital to convert their warrants, and we have to accept that's that's their investment decision. And they will have sold stock, but people are buying stock to see it go up, which is also more important. Our analyst coverage has grown from 0 to 3. Their pricing, I think Mike has us priced at a 2.25 Canadian dollars. Stefan's, I think, is $1.60. Craig's at $1.50. These are independent. I do not control what they write. They're independent evaluation done by the banks across Canada. If we're trading, these are quite experienced men, respected men, respected analysts. And if they're forecasting, in some cases, a 6 or 7-fold increase in stock value, well, I think that's a wonderful validation of what we're seeing in the resource. But also, a lot of their valuations are very much just in the resource. We haven't yet factored in the upside of the exploration potential. Look, the board has remained unchanged since for some time now. We're very focused on it. All the board members have bought their shares on market, converted warrants, or participated in private placements. We have been greatly benefited from the historical knowledge of the project from our advisory board. Be it, Gilson and Rocky, who actually worked at the project when it was in operation in the 80s, or Afonso, who actually found the project for Vale, first found the outcrop in 77, or Johnny, who's ex-Rio Tinto, and great input from Tommy. I really have to have a big thank you to Phil and Mike for their contributions on the metallurgy. Those numbers we put into the market are really quite amazing numbers. You don't see this very often. And to have such high recovery, so, like I said, once you go above 0.1% copper, we get 90% recovery of that copper. So that means all the associated metals, gold and silver, that's attached to that copper, that floats at the same time. It's an incredibly, the benefit to that on the longer term financial studies is just incredible. We talk about this, we do this in-house. We don't take in external contracts. Our corporate social responsibility, our sustainable development goals, or our ESG. We do that in-house. We have long-term employees. There's three fundamentals for me in mining when you look at an investment opportunity. One is clean soils, clean water, and clean air. And now there's a fourth, the clean energy. Clean energy we can bring in anywhere, but you can never attract good work, good employees if they live going to work bring their families into somewhere where the soil's not clean, the water's dirty, or there's pollution in the air. It just won't happen. So that's why that's one of my three fundamental principles for investing in mining: clean soil, clean air, clean water. We are in a region of Brazil. Brazil has massive hydroelectricity, but we are in a region that actually exports a lot of electricity. These are within some of our tenements. I think this one here, Jaru, is approximately about 30 kilometers away from the mine. It's a stable energy grid. It's cheap, incredibly cheap. We can get long-term contracts somewhere between 2.5 to 2.75 US cents a kilowatt. If you look at some of the energy costs, say from the mines in Europe, they are paying anything up to 40 euro cents a kilowatt. I think this is an amazing benefit for us. So when we take a little bit of a back step, a couple of pages up, we talk about that low energy requirements, the soft ore, the coarse grind. Now you throw in cheap electricity, you can understand why it has the very great potential to affect how much cash we need to convert, what is going to be OPEX. By having these very positive attributes on the metallurgy supported by cheap power, well, that's just something that mining companies dream of. And an analogy is in Canada, the Great Sudbury Nickel Copper Basin. There's some very interesting papers out there, but one of the first things they built up in that area was run-of-river hydroelectricity to power those mines, and those mines have gone for over 100 years. Cheap power is absolutely critical for the economics of mining, and we are in a region that is just flooded with cheap power. So we're coming to the last page of the corporate, and we'll move on to the geology, and then we'll go through a Q&A session. Again, it's open to all interested parties. What we're looking there in the background is Cabaçal. You can see we're going up the hill. We have 1.9 kilometers of a deposit. Okay, that resource is 1.9 kilometers long. That is a big mine. That has the potential to be a very large open pit. This is part of our 50 kilometers of exploration upside. Again, VMS belts are known to have multiple centers of hydrothermal activity. That's the hot water that's brought the metals to the surface. We have essentially the entire belt. So our upside is not going to be quantified and finished in 1 year. It's not going to be quantified and finished in 5 years. It will still be going in the decades to come. And that's a real interest to us as a potential operator. But in an M&A sense, if you have a standalone asset, you've still got all the upside intact. I mean, that's just what you dream about. The indicated resource on 52 million tonnes, we're focused very much on that high-grade core, that 40 million tonnes of inferred and indicated. With the ongoing drilling, we expect to convert some of that inferred into indicated. We also expect to see extensions in the deposit, because we, as I've said in the public arena, we never actually got to the end of the metallurgical recovery of the deposit. We drilled out the high-grade core first, and now we're going to be drilling out the rest of it. Metallurgy, I think the simplest way to look at metallurgy is just think metallurgy, cash flow. That's what you're going to look at. How quickly can you take the metal out of the rock and sell it? Because when you sell it, you get cash flow. Metallurgy is that key element of it. And we've talked about the low bond work index and so forth. That was just a general corporate update. This is all downloadable from the website. What I'll do now is I'm going to move on to we're going to walk through from northwest to the southeast, cross sections, and we're going to go do a step through the long section, which is the axe of the deposit. And at the same time, we've got a couple of questions here, and I'll incorporate those questions into the discussion so people can get a perspective of why I think the geometry of this deposit combined with the metallurgy really sets us up to be a low-cost producer. What we're going to go through here are the long sections, which is basically we're going to do vertical cuts from the top of the hill down to the southeast, and then we're going to do cross sections, which are essentially from the left of the page to the right of the page. This again is available from the website. After this, if anyone's got any questions on it, please send an email to info@meridianmining.co. Comes to me, goes to Adrian, and we'll answer any additional questions as we go through. Again, disclosure, just note that Simon Terre was the QP for this. This is a highly respected geologist. We've used very conservative parameters in our grade estimation, and what we've really been focused on is not what we call the smearing of grade. The smearing of grade is when you have a very high grade core, its dimensions are, say, arbitrary, 10 meters or 100 meters. That's the high grade core. If you do not control how the software looks at a deposit, it could take that 100 meters of core, high grade, and then smear it over many hundreds of meters, and you get an overestimation. And an overestimation is just death for resource. We've seen a few disasters of late. So what we've done is been very, very conservative and contained our high grade zones. So again, top tier metallurgy. In our studies, we're going to focus on what we call a multi-phase approach. So the first phase, we'll be focusing on that high grade core. The second phase will probably be centered on the Cabaçal mine, which has got a lot more copper. Pardon me. And then the third phase, this is theoretical. Third phase is when we take out the entire pit. One of the things that a lot of our the analysts that talk to us really like about the deposit is if you drop that cutoff grade lower, it gets much bigger. So what typically happens in these scenarios is once you've paid off your debt to the banks, the project finance banks, and you've done it successfully, you've met all their criteria, they'll come back. We could go back to them, or they'll come to us. Typically, we'll go to them and say, we want to expand the deposit now, refinance the debt, and put higher throughput. And because our recoveries, we don't have a dramatic drop off in recovery with grade, we've actually got the opportunity and the flexibility after, say, years 3 or 4 or 5 to take it from being, say, a hypothetical 2.5 million ton open pit operation where you process 2.5 million tons of mineralization through the plant. We might take it up to 3 or 3.5 or 4 million tons, but we drop the cutoff grade, but we've always got this giant resource that's underpinning this. And this is the great flexibility. We as a junior company could say, look, we can finance and build very easily a 2.5 million ton per annum mill. But a larger company might say, well, we're looking at this as a merger and acquisition, but we want to take it up to 4 or 5 million tons. Does your resource support that? And we can say, yes, it has great potential to support that. But they will do their own, any company that does their own internal due diligence. We've talked about this, the high grade core, there's some 41 million tons of inferred and indicated. You can see it runs the length of the 1.9 kilometers of strike. In the Northwest Extension, it does not have the density of drilling that the Cabaçal mine had with the historical drilling. So there are times where the model, the block model, it'll only sort of look so many meters away to take in information. If there's no information there and we've already restricted, it just comes up as a 0 ton, 0 grade. So this is why we see there's some benefit in doing a part of the drill program going forward is doing this extensional drilling, either up dip or down dip. Up dip is going to the surface, down dip is going deeper, and also infilling some areas for higher certainty. We've talked about this before, so we can go on. We can skip past it. This high grade shallow underpit scenario. This is in the northwest, and that's where we'll start the cross sections, the long sections and the cross sections. So we'll go into the block models. So this is literally Lego. Let's just imagine that a blue Lego block which is stacked together, has got 0 to 0.1 grams per ton gold equivalent. When we say gold equivalent, that means that we've already factored in the metallurgical recoveries. So we're saying 0.1 to 0.3, that's what will be recovered in that Lego block through the mill. This is not a common thing in the junior space for junior companies to do this. This is atypical for production companies and bigger companies, but we wanted the higher certainty. So as you can see, we've got a series of black lines, these long sections. They're going to go from 1, 2, 3, 4, 5, 6, 7, 8, and they'll be progressing to the northeast. So in this perspective, when we go to the next page, what we're looking at here is we're looking to the northeast. So the northwest extension is here. The southeast is down in this, sorry, northwest is on the left-hand side, and the southeast is on the right-hand side. Now, what we can take away from here is you can see straight away there's a much higher degree of density where my cursor is. This is the mining area. And then if you look up to the northwest, you'll see there's this very long, continuous zone of very high grades. This is why we want to focus up there, because I do not have to mine a lot of overlying burden before I get to the high grade. So we're going to do the next step, which is to the next step to the northeast. You can see it's very continuous. We're not seeing any blocks of nothingness in this. It's a very massive mineralization. This is why I talk about the flexibility to increase throughput. Even though we're going to focus on the high grade, this high grade core, this 41 million tons at 1.24 gold equivalent or 0.92 copper equivalent, that's what we're going to focus on. Just go to step 3 again to the northeast. Again, massive mineralization. It's continuous. You'll see there's some blocks here missing. That's more the fact that we didn't have data in that area. As we go to the northeast, the deposit is going to shallow because it dips back to the southwest. So as we go through these sections, you'll see that the bottom of the deposit will rise because we're actually going upwards. Again, you'll see that we go into very robust grades of mineralization at very shallow depths. What we can also take away is, say, the blue, the very dark blue. I would classify that as waste. Probably got no commercial value, no possibility of generating, in this instance, acid generation. We expect that some of this blue will be upgraded with infill drilling because particularly in the historical drilling, it was very common for them not to actually assay the first 20 to 30 meters of mineralization. So when we did the block model, there was 0 assay grams per ton or percentage copper in these areas. And when we've twinned those holes, we actually have sometimes 20 or 30% more mineralization. Okay, we can see here we're going further to the northwest. You can see we lack data here. And where we've lacked data, that's gone into the inferred category. So it's got to be certified. But again, you'll start to see that as we exhaust the northwest extension, that starter pit, we're actually starting to expose the shallow mineralization down here in the Cabaçal mine. So our mine planning is very important, that we manage that so we've got consistent grade of feed into the plant. But the ore body lends itself to that. So we're going to go again to the northeast. It's going to get shallower. You can see that the hill that was on the right has completely disappeared. And now we've still got this large block of mineralization. On that right-hand side, you'll see there's a very large area here that's all white. The reason it's all white there is that it is the host units for the VMS, the rocks that host the gold and the copper. They're actually overlain by a different deposit, a different geology, and that is barren. It's called a gabbro sill. A sill is like a window sill. It's flat. That is barren. So you can see that the end of our pit, our potential pit, is going to be down here where my cursor is. Okay, we've come off the hill. We're getting very shallow now. You can see that the mineralization is sort of at surface, where probably the ore body here is at best, I guess, 75 meters of just continuous mineralization, very shallow, and this is why it's an open pit. We don't have a massive amount of waste above us, but we've got a very shallow mineralized bottom to it. Again, now coming to the very much towards the end of the ore body, or almost at the surface in the northeast, section 7-7. Again, it's still very robust grades, and this is important that when we go to model these things, you know, where's our shallow dirt after the northwest extension? Well, obviously it's going to be this, which we call the eastern copper zone. Okay, we're just about out of the ore body now. It's done. What we're going to do now is walk through the cross section, starting at A dot ash in the northwest extension, and we're going to go down to the southeast. What we'll bring into context here is an open pit. The dimensions of an open pit. There are a couple of the geography, I should say, the geography of the open pit has got a couple of impacts, influences. One is the grade, is there metal there? And then the other one is, you know, how stable are the walls of the pit? You know, because if you do a very steep wall, it will just collapse. And from my experience, a lot of the very stable walls in good rocks are always they can be up to 60 degrees, but often they're sort of 50 to 56 degrees. So when we look at our drilling, the angle drilling is majority done by Meridian. They dip at about 50 to 55 degrees. So this could be an indicative angle that an open pit would be. Now we're looking to the northwest. So on the right-hand side, you'll notice there's this black line coming down the side here. And it dips down to the left-hand side of the page. This is actually a geological unit. And we know that above that geological unit, we have mineralization, and below that we have none. So we can assume that on the right-hand side of the page, when we do our open pit studies, the open pit side on this that's actually to the northeast, will follow this line down here. So you automatically see that there's going to be mining ore. There's a lack of data here, but we know the ore body subcontracts. On the left-hand side, you can see this drilling, which is at approximately 50, 55 degrees. Now, subsequent to studies, this could be the open pit angle. And you can see that there's very little waste that we're going to have to take out. This blue zone here, I think, is more a reflection where we've had this vertical historical drilling that wasn't assayed, so we haven't spread the grade around. But I expect that with infill, that will come up to be more in a recoverable grade. So what I'm getting at in this, my interpretation, and this is going to be sort of factualized through future economic and technical studies, is we expect to have a very low strip ratio. And a strip ratio is how many tons of waste do I have to remove to access 1 ton of ore for the mill. What we're looking at here is the potential for a very low strip ratio. Again, you can see we're on this side, we've got very little data. So we're going to have to drill that out so we can push that mineralization, the estimation up to the surface. And you can see here we've got some quite high grade zones, but we haven't smeared the grade. We talked about the smearing of the grade. What we've done here is we haven't smeared the grade, we've constrained the grade, but you can see there's opportunity to increase both the resource and the grade, locally the grade of the resource. You can see here, very large, massive mineralization. At the moment, in cross section, we are approximately, let me think, that's 350 meters across at the moment. It's a very wide pit. You can see the bulk of this is mineralization. Further infill drilling is needed. Again, this is one of the lower grade areas. It will be mined out very late in the process of the studies because it's low grade. There is opportunity to increase this. Why is that? What we've noticed in our drilling is that where there are flexures in the base, this black line here where we have this, where my cursor is, there's this like an anticline or an anticline is a geological term. It's a flexure, a vertical flexure. We have noticed that there is concentration of high-grade gold in these areas. So we have to, in some aspects, target these areas for some of the infill drilling so we can populate, if there's success, with higher grade metal. You can see here we have an historical vertical hole with some high grade, and it's open. So there is opportunity to extend those higher grade zones into areas where this is almost certainly a lower classification in the third area, but increase that indicated tonnage and locally the grade. One thing I will sort of talk about, just stop here. We have a very large deposit. It's some, like I said, 19 kilometers. We have a massive ton, and we'll do. I think in the future we'll have good results, but it's not going to dramatically change the grade of the deposit because we've got so much of it. Locally within the deposit, it will probably increase, but will it increase twofold the grade? Absolutely no way in hell. It won't happen. But it will make the deposit more robust for our economic studies. But this is the basis of what a mine is. It's very strong. We're heading down to the south now. We'll start seeing some increase in the grades. Again, take note that if we've got these very high grade and very robust grades, to get to it, we're not going to be stripping out a lot of waste. And again, putting the context in that first 20 meters, we've assigned 0 recovery for copper. There could be copper present, often there is, but because we don't know how the oxidized copper reacts to flotation, we've taken that out of the equation. You can start seeing we're going to start seeing an increase in the density of the drilling, the vertical drilling. You can see that it's very continuous across the strike. So we're actually approaching the area of the mine, and we're going to see an increase in grade with the high drilling density. We're getting quite close to now. Where now the deposit is it's over 500 meters across. You can see that our high grade core is supported by sort of an envelope of mineralized dirt. Again, this is indicating to me that we'll have a very low strip ratio. It's up to the future studies to actually quantify that, but my observation and experience in mining is very much indicating this. We had in the Northwest Extension very shallow high grade, and which we can rapidly access. We're going to start to see almost equivalent high grade, but that will take longer time to access. This is why we're focusing on the Northwest Extension. It allows us to produce theoretically. I have to keep saying this because we are under 43-101, but it allows us to access an area with higher payable rocks quicker. Now we're getting close to about 1,000 meters down the deposit now. You can start seeing there's some true waste coming in now. This is the first real indication of waste in the pre-strip. Another benefit of the information that we've gathered and it was paid for by our shareholders is we recovered what we call the underground drilling. So when you've got an underground mine, and this started as an underground mine, you can see they did an amazing amount of high frequency vertical drilling. There's these vertical black lines you can see. But in the middle here, we've got these dots with fan, like a radial trace or a fan. This is called underground fan drilling. And they did this because they weren't getting the gold they thought at the time, because they never underestimated, or they wholly overestimated the impact of the vertical gold vein. So what we can see here is a massive copper gold mineralization. And if you thought the gold was flat lying like they did back in the 1980s, vertical drilling works very well. But what they became to be realized in 1989 is they had a lot of vertical gold. So this is the part of the fan drilling, this grade control. They're trying to control the grade in the mine. We were able to recover that and include that into our block model. Again, you can see that the massive mineralization going all the way to the surface on the right-hand side of the page, and the continuation down the left-hand side. If you were to take an arbitrary theoretical pit, you might think that the pit's going to be edge on the southwest is going to be, say, here. There's a very, very small percentage of waste that we'll be taking out. Again, this will be quantified in future studies, but my observation is this. We're starting to get really into the guts of the underground mine now. You'll see a very large mass of very high grade. What we can notice here is this feature on the top right. It seems to be flat. This is this intrusion, this gabbroic intrusive sill coming in and cutting off the mineralization. We are now over, well, I think we're 500 meters across. We've got high grade across the length of the deposit. We can see both the company's drilling here, these angled holes, the historical drilling from the surface, and the underground radial drilling. Well, what we take away from this cross section is we're not seeing zones of just white, no mineralization. This is a fact. This is why we're very prospective for an open pit. Again, in a theoretical assumption, if we were to have the southwestern side of our pit study saying the pit will come down through this area here, you can see there's only a very small amount of mineralization. Why is this important? Well, there was a recent transaction by two of the majors. In the 1990s, Teck found a big VMS deposit called St. Nicholas, and it's 100 million tons, much higher grade than us. It's 1.2% copper, 1.3 zinc. Principally, it's a zinc deposit, and they just did a joint venture with Agnico Eagle, and it's great for us. It's a great valuation see through that we're seeing these big companies come in and look at VMS deposits for long-term production scenario. The big difference for us is what we can see here, this RL 350, 300, 250, 200. So that they're 50-meter lateral lines. We all mine that our deposit sort of starts at surface, goes down to approximately 170 meters at its deepest. In that deposit, what they've got to do first is strip away a flat layer of about 200 vertical meters. So they're going to have a very high strip ratio. Yet their valuation on that to get their 50% was 250 million for the first shares, another 250 million. So they're for their 50%. So for that deposit that has a wholly different geometry, there's almost $1 billion valuation there. Yet their capex estimation is over $1 billion. Our deposit is shallow. Has a very low push, should have a very low pre-strip, and our internal estimations of the capex required is nowhere near what has been projected by that project that has just been transferred, JV between two of the majors. So this is why we are such an attractive opportunity for us to develop ourselves, but longer term, if there was a merger and acquisition possibility, because the attributes we're seeing here, very large deposit, incredible upside along the belt. We know that our parameters that influence the OPEX are absolutely some of the best you want to have. Very high recoveries, very soft rock, very coarse grind. And then on top of that, we're in an area of Brazil, we have very cheap electricity. Going through the ore body again, you can see this is the only area we're starting to see. So that's 50 meters of potential pre-strip that has some waste that has to come out there. The length of the ore body has this very, very high grade core. This is important when we go to mine planning studies. This is where we'll be able to maintain our grades. This, you can see, this is where the underground mine at the bottom was. You can see there's just a block of high grade. Again, very fortunate to have this, a robust ore body. And this is why if we take our cutoff grade down to, I think it's down to 0.2 gold equivalent, which is pretty much a standard cutoff grade for some of the operating mines in Brazil today, all of a sudden we've got nigh on just under, I think it's just shy of 85 million tons. This is a big deposit. This is why we're actually classified as a giant VMS deposit, the top 4 in size for tonnage. Again, what can I say? Just a bit of a broken record here. Very long high grade, a very high grade core, extensive payable mineralization. and a very small pre-strip. But just again, when you look at those blocks, 5 meters high, 10 meters wide, 10 meters long. This is a very standard block model. And then when we've gone to populate that model with the drilling results, it's very important that we didn't smear that information everywhere. It's a very conservative mineralization done by a guy who's done some of the most successful resource statements in the last period. This is the deepest part of the mine. Approximately, you can see here, we're at about 170 meters. Even with our deepest part of the mine, you can see when we look across, there's only going to be a very small amount of waste that we're going to have to take out that won't be eventually processed. Up here on the right-hand side of the page where the cursor is, that's where we're seeing that Cabaçal dike. Again, same thing again as we go south, east, big, robust mineralization, the start of some waste, but overall, and we're actually out of the ore body. Essentially, we're out of the ore body now. And if we were to look at the angle of the southeast of the pit, well, this is where it would be. And this is mainly this is probably the area of the highest waste, but that's part of the deposit. So look, what I'm going to do now is I've got a couple of questions here. And then if we can follow up, some people have got my mobile, you can ping me a message. I'll just read them. The questions will be anonymous, so I'm not going to actually identify the person, but this is just it is. One of the questions is, look, we have terrible market conditions. What do you perceive as the main issues for the market? Absolutely, we are all aware of the global instability in the market, geopolitical, fiscal, energy policies. That has impacted all mining stocks. One of the questions here is, what do I think the effect will be on the Brazilian election with the project? Left or right in Brazil, they are both pro-mining. There may be, if you are a project that is unpermitted in the Amazon, you may have problems going forward if there's a left-wing government. We don't have that project problem. We're actually way down south in Mato Grosso. It's largely, effectively, we are a brownfields restart. One of the questions here was, when we release information, my internet's a little bit unstable, so I'll stop the share. One of the questions was, when we release information, do we work with our market makers? Well, our market makers are there for stability, not for trading. We never walk across the sales teams. That just can't be done. What we do at times is we will walk across the technical people prior to a release, and they will then, the analysts, and they will then prepare. Actually, sometimes we don't even walk across them. We ring them up at about 7 a.m. on a Toronto morning, and we'll discuss the impact and what we think the news release is. So we do interact with our banks. We've been very successful. We've had great support from Beacon, Raymond James, PI, Cormark, CIBC. We have a very supportive banking industry and banking analysts following us. One of the questions is, are we towards selling the land once we've done the drilling? We don't own our land. We lease the farm. We lease the São Paulo farm. In the time going forward, we'll have to assess how we go forward with our land management. The question was, how many the drilling, how many drill rigs? Well, we've got 2 drill rigs going. They'll probably continue like that next year, where there was an urgency to get the resource out. Once it became very large, we could see that when we discovered the Northwest Extension. We brought another drill rig on. We mobilised an additional crew. We've now cut that back to 2 drill rigs and 2 crews. My question is, how do we move from the poor response of the 43-101? I take that on the chin. There was market sensitivity. We should have led with the 40 million tonnes at just under 1% copper equivalent. That was my error. and at the same time, that's essentially what a market wants. What's the high grade? If you're looking at a different scenario in an M&A or like that, when I was looking at a project as a fund manager, what I look at is how big is the resource, how big is the potential mine, and how quick can you pay it back? It's a different perspective. So we have to be more attuned to the market's desires, but the underlying what we've got is a very high grade resource, which we're focusing on for our open pit studies, economic studies. That's supported by a very large deposit, which gives us the flexibility to increase throughput in our studies. And we have an area in the Northwest Extension, which I explained, which gives us the ability to potentially pay off the project finance quicker. We've got sufficient funds to go take us into Q1 of next year. I don't see any problem with that. We're very thrifty. You can see that how we actually achieved this resource at a cost of $3.5 an ounce. That's something per ounce gold equivalent. That might be one of the best figures you'll ever see in the industry. Will positive drill results have much effect on the current economic environment? Drill results, at times they're just liquidity events. Sometimes they're acquisition events. It depends on the investment philosophy of the person buying or holding the stocks. I am a buy and build person. The purchase agreement says we have to build. I am a buy and build investor, and I've always done that in funds management. Will we be increasing rig count? Well, that's always a question on capital management and reaction to the available capital. If we had another substantial discovery, we've already had the C4A, or potential for expansion on, say, the St. Helena deposit. And let's really also keep in context the down dip of the Cabaçal deposits itself is exploration potential. So again, that's just about capital management, market reaction, but certainly if we had sufficient capital coming down in the future and we had another major discovery, we would certainly consider the mobilization of additional rigs. Question here, what are institutional investors thinking that keeps them away from Meridian's from buying Meridian shares? We actually do. I think we've got probably 2 or 3 accounts out of the US buying through the OTC. We have a couple of accounts buying stock. If you have willing sellers, there'll always be buyers. And at the moment, we do see willing sellers. So you're not going to come into the market, and from my experience, and maybe the different funds have different experiences, you're not going to be an aggressive buyer when you've got willing sellers. Now, willing sellers, unfortunately, are some of our retail guys. I think a lot of our shareholders know is we give a lot of information on the deposit, more than most companies do. There's good and bad in that, but you have to have that interaction. And I guess, but be that interested parties, previous shareholders, current shareholders. And this is again why we're doing this Zoom call today. Get the information out there. Let people make an assessment to buy, to sell, to hold, to increase, or any aspect of the trading in stocks. I think as you can see, our analysts that follow this industry, they're 6-fold, 5-fold, 6-fold our share price projection. So this is where we're very strong. I think we're a very strong buy, and that's their recommendation. But if you've got willing sellers, you're not going to flame the price when you just pick up the stock cheaply. Please remember that at this not too distant time before, I was on the other side. I was the person waiting for the retail or stressed funds to sell. We have seen a lot of funds pull back from the market. Again, there's a whole myriad of reasons. You can look at some of the financial statements of some of the big companies, and one of the things they've said often is how the impact of energy has affected their bottom line, and this is called their share price. Their costs have gone up, their dividends have gone down. I can't stress again why I've sort of harped on in the market about energy costs that we're looking at. cheap, industrial, stable energy supply is very critical. And if you don't have that, you've got all types of problems. If you're a project that's dominated by diesel fuel to power your electrical gensets, you've got a lot of trouble. I just got a couple of quick, I'll keep going through these questions. Yeah, look, there may be some elementary benefit from open pit to underground comparisons. Underground mines, what's the comparison between an open pit and underground, the benefit for us? If you're an underground ore body, there's a couple of deposits out there. There's one that's 1,000, I think it starts 200 meters. One company's got a VMS deposit, starts about 200 meters below surface and it goes down 1,000 meters. They're going to have to do many years of underground development, drilling tunnels, preparing the ore body to mine it. Okay, they've got to go down underground. It's expensive to do this. Underground miners are not cheap. And then what that means is you've got to provide a lot of cash up front to pay that, because it's been many years before you're going to produce a commodity or an ore to process to get cash flow. And that is expensive now because you've got to borrow that money. The benefit we have with an open pit mine is you have, in our instance, a very short time between moving the waste off the top of the ore body and getting into the ore body and then moving that to the mill, produce the commodity and sell it. It's a very short time, and that's the benefit. The other benefits I can identify is you don't, unless you're one of the giant deposits, the amount of metal that you can extract is smaller. And because it's a lot smaller, it means it's going to be more expensive to mine than to say an underground. So that means you've got to increase your cutoff grade. That means you've got less tonnages. Now, in a VMS deposit, typically you have a high grade massive sulfide core, and then you've got the underground, the feeder that fed that. At Cabaçal, our massive sulfide, we believe, is down to the southwest, and the feeder, that low grade feeder system, that low grade for underground, is at the surface. But when it's at the surface, it's in completely different economics. Underground mine, we're probably looking at 60, 65, 70, 80 US dollars net smelter return cutoff grade. What that means is the ore body has to be above $80 or 60 or $80 before you can mine it economically. In open pits, it's completely different. We could be economic at, say, $25 or $26 of metal in the ground. So if our metal content is above, say, $20, then it's profitable. It covers all the costs. And that's the big difference with underground and open pit mining. When we say the top 4%, one of the questions, what's different on the top 4% of mines? Well, the St. Nicholas deposit 2 weeks ago got given $1 billion valuation. It's an open pit. Top percent, they're big tonnages. They are valuable ore bodies. That's why we're looking for with our project. And I touched on one of the questions here is on the concentrate, the copper concentrate. As I said, the studies that we've done today, it very much reflects what they did in the past, although they're digging the early stages of the mine. We see 80% of the dollar value of the mineralization can be gathered in the copper concentrate, and then 20% will be producing gold doré, gold silver doré, the silver that follows the gold. Again, that's the benefit of having this very highly desirable copper concentrates, because at the moment, one of the big suppliers is Chile. And this has actually been, if you're in the copper game, the interest of copper mine, which we essentially have, 80% of our value, our potential commercial value or revenue is from selling copper concentrates. Now, just got to bring it up. Last week, there was a bit of an earth-shattering movement within the copper industry. One of the biggest suppliers is Chile. There's a company called Codelco, and you can research this. They've just come out and told the European Union that if you want next year our copper concentrates, you're going to have to pay, I'll give you the exact amount. What they basically said, copper is trading down at the moment, but they've said to the market in Europe that if you want to buy our copper concentrate, so Codelco provides base load, they provide massive tonnages, they've got giant mines. But if you want to buy our copper concentrate, well, we trade it, we price it through the London Metals Exchange. For every ton of concentrate you want to buy from us, the largest exporter in the world, you will have to pay a $235 a ton premium. I mean, that's staggering for them to announce that. So if you think copper's going to stay down at $3.40, no, copper is going to go up. Everyone's going to be looking for it because Codelco is saying, if you want our stable supply, you're going to have to pay a premium. Now, the next part of this, which I thought was very interesting with respect to the commercial potential of the deposit, was two of the biggest smelters in Europe, Arubis and the Austrian group. I can't pronounce that, not the word Bixleg. They've come out and said that they're going to increase their premium to buy from them from $123 to $228 a ton. So they've already factored in this increase. Some element of Arubis's increase is almost certainly due to their high energy costs. The Austrians are charging even more for their low carbon copper. I'd love to understand how they came to that, but all well and good. A lot of industrial suppliers want low carbon copper, but there is going to be a dramatic rise in the price of copper, because if the big guys are saying, if you want our copper, you're going to pay $200 or $250 above the price. Now that means everyone's going to go look for copper because they'll be saying, oh, we can sell you some cheaper. That is really quite an interesting aspect for this project. This question is, one of the guys said, why don't we build a smelter? Smelters are very expensive. We would need, if say in an M&A scenario, somebody might say, oh, look, we want to have build a smelter, but we want a 200 million ton deposit. Well, we have to find another Cabaçal. If we were to find another Cabaçal deposit, then you'd probably a larger group might have the justification to build a smelter. Look, we have seen, one of the questions here is just on the share price pressure. Yes, we have seen share price pressure. I think that's more related to a small group of supporters who they want to raise some capital for convert their warrants. It's my strategy in this has always been to buy and build. If we know, as we said in the market, the consumers and the producers are saying, if you want copper, you're going to pay more, and this is obvious. Well, I don't sell copper stocks, and there's a lot of the analysts are saying, well, there's confusion. You're saying that you did a gold equivalent. I said yes, that was because that's the majority of the value, the in situ value, but the future commercial use or commercialization of the product is 80% through copper concentrates. So we have a highly desirable copper mine. One of the questions, again, on concentrates is, again, what is any additional attractiveness? Well, what I'd say is, we touched on this before about when companies blend copper to maintain cash flow and so forth. They blend with dirty concentrates, or they buy copper concentrates with rich payable content of gold and silver, like the potential concentrates from Cabaçal. And one of the biggest contributors of this copper concentrate with these high payables of gold and silver was Indonesia, the Grasberg and the Little Grasberg deposits. These are giant deposits. They moved, I think this open pit when it was mining was moving something like 600,000 tons a day. It's enormous. And it produced very good high grade copper, gold, silver concentrates, which they exported principally to Korea, Japan, and China. Indonesia made an announcement many years ago that starting from X day, no copper concentrates will be exported from Indonesia, and they started building a smelter. That smelter is nearing completion. It should go into pre-production 2023, full production 2024. That means those copper concentrates don't go into the market. They'll make cathode and they'll ship it to China. So that's, again, we're seeing if smelters need copper concentrates with high payables of precious metals, and you're seeing a massive volume coming out of the market, we can never replace that volume. But certainly we now have an attractiveness, an additional attractiveness into the market. One question here was, okay, the question was the remain, talked about that, where there was old mines workings, they took zero, where we had actually digitized the remaining columns where they left for stability, they were included in the model. What I'll do is I'll just, one last thing I want to show everyone. I can't actually show you the entirety of the report because it was a confidential report, but I think this is actually very important for everyone to understand in respect to the copper market. Just let this load up. What this is, it was done, sourced by S&P Global, and they've interpreted it. And the question was, how will the energy transition, the push for electric vehicles sort of affect the copper market? Because a lot of companies, they really do promote this, and I'm all for that, for the promotion of the copper mining industry. But what we have to really assume is how big is that growth going to be? It's not particularly big. The real growth in copper is 70% of that growth, what we're going to be consuming in, say, 10 years' time or 20 years' time. It's not going to be coming from electric vehicles. It's going to be coming from non-energy transition demand. That's your copper cabling, your washing machines, your white goods, phones, transmission, there's transmissions factored in there, the general use of electricity. That's our growth. I understand the attractiveness of promoting electric vehicles. Yep, not a problem for me to promote that. But that's really not going to drive the growth in copper concentrates. There'll be growth. I think the growth will be in the general industry, except that we turn on our lights, we turn on a computer. There are uses in medical for copper, anything to do with electricity. So your entire day revolves around copper. What I'll just do is, we've been going now for an hour and a half. We'll probably fix it up in a moment. I'm just going to unmute everyone. I actually don't know how to do that. Let me see if I can unmute anyone. So what I've done is I've just allowed anyone to unmute themselves. So there's a little red button. If you want to unmute, you can. Or if you've got any questions, you can actually, I think there's a raise a hand button. I'll just see if I can. There's also the chat option. If there's anyone who wants to ask a question, you can actually do it now. I think, Mr. Lindell, I think if you've got a question, you can ask it. You're unmuted.
Oh, yeah. Am I the only one left holding the bag?
No, there's quite a fair few people still on, though.
Oh, okay. So I'm trying to figure out, okay, we got a high-grade, shallow resource with great recoveries. And here we've got all these ratings by our institutions. And they're calling for $1 or $2 or somewhere in between. So why is it we can't support the stock somewhere around 50 cents? That's what I don't understand.
Yeah, Jerry, it's a frustration, a daily frustration for me. I would actually say that we are not alone, not out as a junior or as some of the mid tiers in having. When you've got a group of analysts coming to a consensus on growth on your company's value, that it hasn't yet materialized, and I think that's two aspects. We saw the share price recently come off, and I attribute that to more to people trying to convert to warrants. There was the initial reception of the resource statement. We've had to work hard to really get the upside that's there.
The institutions are recognizing that this is well over $1 value, and none of them are taking a bite.
Well, if we look at the last couple of days of last week of trading, I'll just get the numbers here. Shares, there's been some good, strong support from some high net worth retailers, investors.
Well, I'm looking at all of 2022.
Yeah.
And it's been very skittish at best.
Oh, look, and we've seen this a general decline in the interest in commodities across the market. My job now, and my job has been all this year, is to bring into the market the realization. What I will say is our initial drop that occurred in May and June, that was very disappointing.
Especially when we signed up with the TSX. So did we jump the gun on that?
No, it's actually been quite interesting for us. We have had more. We've had more meetings and follow-up meetings and additional meetings. That essentially in the third quarter, the institutional market disappeared from the TSX. A lot of them were having redemptions because just their investors were nervous. I think now there's a reconciliation coming in. They're saying copper projects are the ones we have to buy, and certainly S&P's report. I'll just stop the share there because my internet's playing up. The S&P report, the open communication by Codelco saying, don't care if you want our dirt, our concentrate, you're gonna have to pay $280 a ton more. That's if you don't want it, you don't get the volume. Almost certainly, I'd assume that a lot of the Chinese smelters have gone to Codelco and said we will pay $280 above market rates to secure it. So if you've got one major client saying we've got 280, we'll pay this amount more, well, they're going to go to all the clients, so you're going to pay more for our concentrate. So this, my view is, we're going to see a recognition of copper mines, and I think this is what can be one of the drivers for the increase or the revaluation in line with our expectations of our share price. Certainly, we were dramatically affected by the decline of the copper price, the decline of the gold price in the first 3 quarters of the year. We were very much affected by the impact of sort of global instability. Some of these things are just out of my control, but I will say that we've had a lot of discussions with the groups over the last couple of weeks, more so than we could expect. August, of course, everyone goes on holidays, and we're coming towards the end of the year. So we will work quite hard to drive that interest in the equities and get the aggressive buying of the stocks. If we have willing sellers, you know, it always makes it hard, but a lot of our people are very tight. I communicate on a daily basis with all our shareholders. Those who approach me or they call me, Jerry, I respond straight away. It's my job to take care of the shareholders' interest.
Just to finish up there, I'm looking at 2000. Is it going to be 2023 when we're going to have a re-rating of our gold and silver prices? Because obviously some of the gold prices have moved up because of the US dollar.
Yeah.
I'm curious where we're going to be sitting next year at this point.
Yeah, it's interesting. I'll touch a little bit on that. Gold is two aspects. One is a geological one is a monetary one. And if you ever have a mining guy talking about a monetary policy on gold, you've got to be concerned about it. I won't give that answer. What I'll do is I'll give a perspective of somebody who works in the monetary industry. I'm a geologist, I guess. I'm from mining finance, but in the aspect of the financial impact on the gold price, the US dollar has been pushed very high on valuation, and that has driven down the gold value. It's always been the case. Financial groups that I talk with, and we talk with groups, not financial analysts. We're talking about guys who manage multi-billion dollar funds. Their expectations is that there's going to be realizations in the financial markets that the dollar has been oversold, and it will retract in Q1 into Q2 of next year, and that should see a re-rating on the gold price. That's a perspective from a financial house. I always avoid, as a mining person, talking about the impact of finance on the commodity prices, particularly one like gold and silver, which are a dual purpose on gold as a currency. So on the aspects for me is very quick, soft dirt, very easy and cheap to mine. And on the financial houses, what they tell me is the US dollar's been overpriced. It will retract in 2023, and you will see a revaluation of the commodity, the metal commodities, gold and silver.
Thank you for your answers. Appreciate it.
Yeah, sorry, Jerry, I'm not an economist. I am a mining finance person. Anyone else? Randy, did you want to ask a question, mate?
Yeah. What is the next sort of critical timeline on our agreement with the vendor that we have to buy?
The next critical timeline is August next year. We will put into escrow funds. When we transferred to the main board, we'd had an agreement whereby the payment that was due with the, I can't remember which exact clause it was, that has been delayed until August next year. And what we'll do is the bulk of the payment will go into escrow in August next year, and we'll start doing, I think, this set amount from a very small amount, some $20,000-$30,000 a month from January onwards. They're really, you couldn't ask for better partners. They see the value. They've been on the mining stocks. They saw the value of their equities going on to the main board, so they facilitated that for us.
One last question I had was, what does a feasibility study cost potentially when we have to get to that stage?
You can look at, there's two ways to answer that question. There's a traditional way where you can say it can be 2% of capex. That's like an average number that people throw around. Depending on the group who do it, a feasibility study could cost anywhere from, say, $8 to $14 million US. What I've been stressing when I'm chatting to engineering groups is I'm not going to accept that they reinvent the wheel. We've been working with one group now, Asenco, for a number of years. Just, they did some internal work on their internal study that we did at the start of the year. They were very good. There's other groups that have talked to us. It is dependent on who the engineering firm is. You want to go for one of the Rolls-Royce giant ones, it will cost a lot of money. But we're not building a 100 million ton per annum plant. We are building a small, financeable, but still quite big. 2.5 million tons is not a small mine. It is quite a big mine, but there are giant mines that can cost a lot more.
Thank you.
What am I do? If anyone wants to ask a question, you can unmute yourself. But if there's nothing else to do, no one else got a question. I think Mrs. Clark's got the dinner on the table. It's just gone 8:30 here in France, and I'll close the meeting down. It's not a meeting; it's just a presentation. Just want to thank. There's quite a number of people have turned up. Or just want to thank everyone taking the time out of their day to discuss the company and the project. At any time you've got a question, please email me. Some of you've got my mobile number. Give me a call. Always happy to answer the shareholders' questions. Okay, I'm going to terminate the meeting now. So and might even have a nice weekend, and we'll be in touch. Thank you.
Thank you, Gilbert.
Thanks, everyone. Thanks, Jake. Ta.